Revenue recognition is a fundamental accounting principle. It dictates how and when companies report their income. This principle ensures that revenue is recorded when earned, not just when cash is received. This provides a more accurate picture of a company's financial performance. Accurate revenue recognition is crucial for several reasons. First, it helps stakeholders understand a company's true profitability. Second, it builds trust and transparency in financial reporting. Finally, it ensures compliance with accounting standards. Without proper revenue recognition, companies could misrepresent their financial health. This could mislead investors and creditors. Therefore, understanding and applying revenue recognition principles is vital for all businesses. Recognizing the need for a unified approach to revenue recognition, accounting standard setters introduced ASC 606 and IFRS 15. ASC 606 applies to US companies, while IFRS 15 is the global standard. These standards provide a single comprehensive model for revenue recognition. They aim to reduce complexity and enhance comparability in financial reporting. The core principle is to recognize revenue when a customer obtains control of a good or service. The introduction of ASC 606 and IFRS 15 marked a significant shift in accounting practice. Companies had to adapt their systems and processes to comply with the new standards. This involved reviewing contracts, assessing performance obligations, and updating accounting policies. Both ASC 606 and IFRS 15 employ a five-step model for revenue recognition. This model provides a structured approach to determine when and how to recognize revenue. Step 1. Identify the contract. This involves determining if a valid contract exists between the company and a customer. Step 2. Identify the performance obligations. This step requires identifying the distinct goods or services promised to the customer. Step 3. Determine the transaction price. This involves determining the amount of consideration the company expects to receive in exchange for the goods or services. Step 4. Allocate the transaction price. If there are multiple performance obligations, the transaction price is allocated to each obligation. Step 5. Recognize revenue. Revenue is recognized when or as the company satisfies a performance obligation by transferring control of a good or service to the customer. The implementation of ASC 606 and IFRS 15 has had a significant impact on businesses. Companies have had to invest time and resources in understanding and implementing the new standards. One of the key impacts is on the timing of revenue recognition. For some companies, revenue is now recognized earlier, while for others it is recognized later. This can have a direct impact on a company's profitability. Another impact is on the level of disclosure required in financial statements. Companies are now required to provide more detailed information about their revenue recognition policies. This enhances transparency and helps stakeholders understand how revenue is generated. The new standards have also led to changes in business processes. Companies have had to review and update their contracts, billing systems, and internal controls.